Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week at everything you need to know in 90 seconds at 9 o'clock with news that China's woes are spreading and the impacts are deepening. But first, the issue of an internationally coordinated digital tax on the global tech giants is back in the limelight as the US tries to do an end run around the OECD BEPS proposals. And the annual Warren Buffett letter to shareholders was out over the weekend, but this one contained no special revelations. It did report strong earnings, but it didn't say who would take over from the 89-year-old legendary investor. He also wants to see corporate CEOs supervised and reined in more effectively by boards of directors. And the coronavirus now seems to be spreading out of China in a significant way, and not just by travellers from China. Italy, Iran, Japan and South Korea all seem to have a growing problem. There are now 2,000 plus confirmed cases outside of China and rising sharply. It now threatens to become a pandemic. And economically, supply chain risk is the next big problem. And in China, the existential risks to the SME sector haven't gone away. If anything, they're building despite emergency loan approvals. Car sales have ground to a halt nationwide. Dealerships are closed, and the first week of February, less than 1,000 cars were sold in the whole of China. And this is in 2019, this was the car market larger than the USA. And China's property market has also ground to a halt. It's a nervous time for public policy officials who continue to reassure that the downturn will be temporary and there will be a strong bounce back when the crisis passes. It is that hope that is keeping commodity prices from collapsing. However, steel production has restarted, but stocks are building very quickly on weak demand and calls are being made to scale back or even halt production in the steel industry. The giant United States economy is feeling the impact too. In fact, the latest PMI data for the US reinforces these risks. Their factory PMI has stalled and their services PMI is now contracting and a sharp move lower. In this survey, new orders fell for the first time since this metric began in 2009. In fact, our Fed governor has called on Congress to plan for a recession. Through all of this, the IMF has again trimmed its 2020 global growth forecast, now seeing 3.3% growth in 2020 and 3.4% in 2021. These forecasts still rely on a sharp recovery from the coronavirus impact starting in the second quarter of 2020. But markets aren't convinced. Equity markets have turned lower at the end of last week, with the Wall Street's S&P 500 down more than 1% on Friday, and that takes a 1.3% loss for the week. And European markets were lower by nearly as much as well. Bond markets yields have fallen sharply at the end of last week. The US Treasury 10-year yield is now just on 1.47% and lower by 11 basis points for the week. Gold has also made another sharp risk-off move upwards to $1,643 an ounce, and it has accumulated more than $60 rise for the week and a remarkable 3.9% advance on top of the prior week's 1% rise. And US oil prices are unchanged overnight at just on $53.50 a barrel. The Brent benchmark, however, is lower at just on $58.50 a barrel. And the Kiwi dollar will start today at just under 63.5 US cents and a 1 cent fall for the week. On the cross rates, we've held at 95.9 Australian cents. Against the euro, we're also down 1 cent for the week at 58.5 euro cents. That means our trade-weighted index is now at 69.5 and its lowest since November. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.